Hello. Today we're going to talk about the 2024 outlook for the financial markets, and we're seeing that the recession expectations that seemed so certain to arrive in 2023 may have simply been delayed. At the beginning of the year, US 10-year Treasury yields were at 3.9%, and the US Fed fund rate was forecast to peak at 5%. Meanwhile, we can see that the 10-year Treasury yield peaked at 5%, and as soon as we got there, we saw a significant decline of over 100 basis points in the yields of the 10-year Treasuries. And the cash that drove the US economy in 2023 will run out in 2024. Excess consumer savings are waning, and higher interest rates are having the inevitable effect on demand, both for goods and services, and particularly housing. Nonetheless, I don't think that the slowdown will end in recession. Generally, I would say you should expect US quarterly GDP growth to weaken at the beginning of 2024, but only briefly. You should expect that the slowdown will end in recession, and the expectation that the recession will be severe and prolonged is exaggerated in my view, and that's why I expect that the US quarterly GDP growth numbers is just going to weaken at the beginning of 2024, but only briefly. The other expectation is that core inflation is to moderate further based on the view that several quarters of below trend GDP growth will be enough to return core personal consumption expenditures PCE inflation to the US Federal Reserve's 2% target, albeit not until 2026. The Fed's patience in allowing inflation to exceed its target for so long is one of the main reasons why the inverted yield curve, which seemed to signal a recession so clearly at the beginning of 2023, will likely turn out this time to have been a false alarm. Another region where many investors failed to predict the trajectory of growth was China. The belief that had been that China would experience a reopening like those seen in the US and Europe with significant pent-up demand after 3 years of zero COVID policies poised to spur strong growth. This seemed to be the case initially, but the rebound faded much sooner than expected, and Chinese households had not accumulated enough savings as those in the US and Europe, as government support was far more modest and worries about the property market dampened consumer and business confidence. Until China's authorities take more forceful measures to address insolvencies among property developers and indebtedness among local governments who depend on property sales for revenue, economic growth will likely continue to disappoint. Trade relations with the US will probably also remain difficult, regardless of who is elected the next president. Europe is the region where pessimistic forecasts were largely realized and where pessimism is potentially still merited. Europe has faced a similar increase in policy rates as the US and a bigger jump in energy prices, but without much fiscal stimulus. The Eurozone may well experience a mild recession in 2023 and will hardly grow by some estimates in 2024. Another external shock could easily tip the region into a deeper recession. For all that, you should not see inflation decelerating much more quickly than the US, meaning outlook on Europe is essentially one of stagflation. A US recession could be needed to get inflation back to the Fed's target level of 2%, and this could stabilize a higher level. The easy gains from normalizing supply chains and the end of revenge travel may already be behind us. Deglobalization, constrained labor markets, and energy transition investments are all inflationary factors. Moreover, as wages continue to be on higher and extended levels, there could be a US recession in sight, as a US recession could still be needed to get inflation back to Fed's target rate of 2% if inflation stabilizes at a higher level. The easy gains from normalizing supply chains and at the end of revenge travels, this is all past. And wages are catching up with inflation, and the increase in real wages and incomes could lead to a reacceleration in consumption. The unprecedented disruptions of the last 4 years have made economic forecasting particularly difficult. It was always difficult, but this time it is really a challenge. Investors and central banks have thus had to imply simply awaiting the next batch of economic data to see how growth and inflation were evolving. Forecasting has hardly become any easier, but this is not an excuse. At the end of the day, we all have to live with the same data sets that are being published. And finally, I have to note that the geopolitical landscape is becoming increasingly complex and challenging, with tensions evident from Ukraine to Taiwan and now Israel. Although geopolitics and the electoral landscape are likely to have significant impact on markets in 2024, it is not currently to assign uh, meaningful possibilities to potential outcomes right now. Therefore, it is still going to be a challenging period going forward. And we would say that the extreme volatility that we have witnessed in 2023 in the macroeconomic narrative, or narrative volatility, if you want to call it like that, in addition to the heightened volatility in the financial assets, especially in the fixed income markets, the asset allocations used for 2024 must also incorporate these levels of uncertainty that are currently driving the volatility in the markets. Market expectations moved skittishly from recession to soft landing to overheating and back again and again. The narrative at the time of doing this report is one of a soft landing, and that inflation can return to the main central bank's 2% target without materially weaker growth. There are many reasons to be less optimistic, but risks are easily skewed towards weaker growth. This scenario would likely result in lower bond yields and lower equity prices, as expected earnings fail to materialize. Market valuations are starkly disconnected with elevated bond premia and comparatively low equity risk premia. As a result, combining the assessments of fundamentals and market valuations or risk premia, the highest conviction asset allocation view for 2024 is being long duration alongside caution on developed market equities. And the fundamentals, especially coming back to this high conviction call on long duration, fundamentals and valuations are the two chief drivers of asset allocations. And looking at 12-month investment horizons, they both support a long duration stance. Consensus US growth expectations for 2023 ratcheted steeply higher over the year as government spending and the rundown of COVID era excess savings offset the impact of meaningfully higher and tighter monetary policy. We are skeptical of the more optimistic forecasts for 2024 growth, where caution was quickly replaced by a doubling of real growth expectations from last summer's low point. Instead, I think you should beware of the fact that 525 basis points of rate hikes in the US, that this will work their way through the US economy in 2024, absent the two chief drivers that propelled 2023 growth, namely the doubling of the US fiscal deficit and surplus savings, which of course have been broadly depleted in the meantime, and particularly by lower income groups. US consumption could slow and should slow as savings levels normalize, correcting for the sizable overshoot to real incomes and other indicators of consumption. Business investment, meanwhile, could be considerably weaker, to be sure. Leading indicators suggest investments should be falling, not growing by 10%. And the other point is that there's also downside risks to an already struggling Europe, with leading indicators continuing to deteriorate and with a meaningfully tighter financial and credit conditions to boot. If you would like to receive further updates on what's going on in the financial markets, please like and subscribe. Thank you.